On paper, a scaling enterprise looks incredibly healthy. Sales are up, and operations appear smooth. But beneath the surface, cash is quietly draining away. This leakage is driven by process debt, the compounding financial drag created when a company relies on manual, outdated back-office workflows that buckle as the business grows. Manual reconciliation means matching internal ledgers against bank statements line by line. This feels safe at 50 transactions, but when that workload scales to thousands of transactions, human diligence simply cannot keep pace with machine-generated volume. Cross-checking all those lines takes time. For a complex organization relying on spreadsheets, finalizing the monthly financial close routinely consumes 10 to 15 days. By the time the books are finally closed, the data is already 2 weeks old. Leadership is forced to spend half the month making critical strategic decisions based on historical guesswork, entirely blind to their actual real-time cash position. Relying on humans to process that much raw data introduces an immediate risk. Forensic data shows that between 88 and 90% of all finance spreadsheets contain at least one material mistake. A tired clerk manually typing data might accidentally hit an extra zero on a vendor payment. In a dense spreadsheet, that single transposition error quietly turns a $10,000 invoice into a $100,000 loss, often sitting undetected until an audit. Catching those mistakes requires endless review cycles, introducing a massive labor tax. Modern finance teams lose up to 60% of their working hours strictly to downloading reports, reformatting cells, and hunting for discrepancies. This bar chart breaks down the unit economics of that labor waste. Manually processing a single invoice can cost an organization $25 in fully loaded staff time. An automated processing system brings that exact same cost down to under $5. Organizations are paying premium, six-figure salaries to highly educated financial professionals only to assign them rudimentary data entry tasks that a script could execute in seconds. Forcing skilled accountants to perform repetitive, low-value work creates systemic risk. 81% of accounting professionals report that the manual month-end close severely disrupts their personal lives, driving exhaustion and high turnover. When an overworked senior accountant finally quits, they take the undocumented custom logic of those spreadsheets with them. The process memory walks out the door, and the department's workflow breaks down. To eliminate these cascading failures, finance teams are abandoning manual entry and migrating to automated AI-driven reconciliation platforms. These systems connect directly to bank feeds to ingest data continuously. They apply fuzzy matching algorithms that tolerate minor discrepancies, like a payment posting a day late, to instantly pair up to 95% of incoming transactions without any human intervention. The workflow completely flips. Instead of spending hours cross-checking thousands of matching records, accountants now solely investigate the 5% of anomalies the system flags. By clearing transactions daily, the month-end close compresses from a frantic 2-week scramble down to a predictable 3-day cycle, and transaction error rates drop well below 1%. In preparation for its initial public offering, Reddit deployed this type of algorithmic automation. They compressed their closing timeline by 60% and saved an estimated $6 million in the process. Facing immense transaction volumes across its retail network, GameStop upgraded their systems, eliminated 750,000 manual entries, and achieved an 82% first-time algorithmic match rate. At an even larger scale, global resource management firm Suez secured £15 million in annual operational savings derived directly from improved data visibility and automated processing. The technology enables a human-in-the-loop model. It removes the mechanical sorting, elevating accountants from data entry clerks into strategic analysts focused on financial planning and capital allocation. The manual spreadsheets and brute force effort that got a company to its first million in revenue will actively prevent it from reaching 10 million. To scale sustainably and stop burning cash, businesses must stop paying humans to do a machine's job.